In 2014, a man named Uri Raffaelli underpaid a tax bill. Not by thousands, not by hundreds, by $8.41. For that, the county took his house, sold it, and kept the money. You can pay off your mortgage, you can hold the deed in your hands, and you can still lose everything over a number you didn't even know you owed. Because here's the truth no closing agent will ever tell you. You don't own your home. You rent it from the county. And tonight, we're going to read you the lease. Start with what we think ownership means. You sign the papers, you make the payments. One day the mortgage ends and the house is yours, free and clear. That's the deal everyone believes they're buying. But there's a clause underneath it. Every year, the county sends a bill, and if you don't pay that bill, you lose the house. Not the bank, the county. Ask Geraldine Tyler. She was 94. She owed about $15,000 in back taxes and penalties on her condo. Hennepin County, Minnesota, took it, sold it for $40,000, and handed her back nothing. In 2023, the Supreme Court of the United States ruled, unanimously, that keeping the extra $25,000 was unconstitutional. Read that again. It took the highest court in the country to decide she was owed the difference. Not the house, just the difference. Because on the question of the house itself, the county was always allowed to take it. There is no version of true ownership where a stranger can sell your home because you missed an annual fee. That's not ownership. That's a lease. And the landlord is the county. So what's the rent? Here's how it's actually set, and almost no one is taught this. Your bill is two numbers multiplied together. The first is the assessed value, what the county says your home is worth. Not what you paid, not what you'd sell it for, what the assessor decides. The second is the mill rate, the tax per $1,000 of that value set by the county, the city, the school district, all stacked on top of each other. Multiply them, and that's your rent for the year. Notice who's missing from that math. You. And here's the part that quietly drains people. The county can reassess. Your home's paper value goes up, and your bill goes up with it. You didn't renovate. You didn't add a room. You changed nothing. The number just moved. In some places, it moves fast. In others, an assessment cap slows it down, which sounds like a gift until you realize what it creates. Two identical houses on the same street can owe completely different amounts. Same house, different rent. Decided by a formula you don't control. Now let's add it up. Because the lease has one feature no real lease has, it never expires. Take a typical American homeowner. In 2024, the average property tax bill came to about $4,271 a year. Hold that flat. No increases, no reassessments, the friendliest possible assumption. And over a 30-year mortgage, that's roughly $128,000 paid to the county, on top of the house you already bought. Now, go where the rent runs high. In New Jersey, the median property tax bill is about $9,500 a year, on a median home worth around $428,000. If that stays flat for 30 years, and it won't, it'll climb, you'll hand the county more than $286,000. That's 2/3 of the price of the house. A second time. And on the day your mortgage finally ends, the bill arrives again. And the year after that, the rent does not stop. It just changes whose name is on it. Here's where it gets strange. Meet two men. Same age, same income, the exact same house, same square footage, same value. Call them Mike and Dave. Mike's house sits in New Jersey, where the effective property tax rate is the highest in the country, about 2.2%. Dave's identical house sits in Hawaii, where the rate is the lowest, about 0.27%. Same house. On a $400 home, Mike pays roughly $8,900 a year. Dave pays around $1,000. For the identical house. Mike isn't getting a better house. He isn't getting 8 times the roads or 8 times the protection. He's just standing on a different patch of ground, paying a different landlord, a different rent. Over 30 years, that gap alone, same house, same life, comes to more than $200,000. The house didn't decide that. The county did. The price tag tells you what the house costs. It never tells you what the ground costs. Every year, forever. Which brings us to right now. For the first time in decades, entire states are seriously debating whether to freeze, cut, or even eliminate the property tax. In Florida, a measure to wipe out most property taxes on primary homes is going in front of voters this November. Analysts estimate it would pull roughly $25 billion a year out of local budgets, money that funds schools, roads, fire, police. We're not here to tell you how that should go. There are real arguments on every side, and they belong to the voters. We're here to tell you why the question even exists. It exists because, somewhere underneath all of it, millions of people did the math we just did, and realized that paying off the mortgage was never the finish line. That the ground beneath the house was always rented. You can own the building, you can hold the deed, but the land it sits on answers to the county. Every year, for as long as it stands. You don't own your home. You hold a very long lease. And now, you've read the terms.